Welcome back to the Atomic Level, the show where we decode the matters of wealth, one insightful conversation at a time, so that you can grow and protect your net worth and your net happiness. I'm Chris Snook, and today I am joined by Dave Lambert, who is Managing Director at Right Side Capital Management. Dave, welcome to the show.
Thanks so much. Great to be here.
I love right on the homepage. We're going to learn about what this means, but it says the VC with no BS. So before we get into your approach to early stage and venture markets in today's insanely exponential world, I want to unpack for the audience your career arc and where you kind of came from and what got you in this seat up in San Francisco. So talk to us a little about your background, kind of whatever you think is relevant, what shaped your thinking, and then we'll have a good long conversation here.
Yeah, happy to do that. So my background, mostly sort of entrepreneurial from when I was even a little kid. So I grew up in Denver, Colorado. After high school, moved out to the San Francisco Bay Area to go to college. That was sort of the late 1980s. I'd really always been entrepreneurial growing up. So one of my businesses was a lawn mowing business, with a friend in high school. Even when I was, late elementary school, I think I baked a cake one day after school and walked around the neighborhood selling pieces of cake to people I didn't know. And then, I came out to the Bay Area, went to Stanford, sort of same thing there. I had one normal job in my life, which was my freshman year in college. I worked as a bank teller at Wells Fargo. And then after that, it was sort of all more entrepreneurial stuff. I got a job as a salesperson at a local computer company. I did a sort of a MLM painting, business, or called Student Painters, where I was trained, and then I hired and trained painting crews for the summer. And right out of school, I sort of, some weird circumstances, fell into a very small amount of money, $10,000, a couple months before I was going to graduate. Wasn't sure what I was going to do, but I knew I was never going to go work for a large company. And I ended up starting a computer hardware company with with a partner, my girlfriend at the time. And we launched it the month after school, ended up building, running that for over a decade. And we made high-end workstation servers, networking services for mostly the corporate world in the Bay Area. Sold to a lot of the .com 1.0 companies in the late 90s. Almost got blown up and went out of business, when that, the music stopped there, but, turned it around and got back to profitable, and then launched a computer software company, sort of while that was still running in the early 2000s, called Work Metro. We did online job boards, mostly up and down the East Coast, like workpittsburgh.com, workbaltimore.com, raised money from angel investors, angel group, venture capital firms, sold that to a competitor in early 2008. And then really Right Side Capital is, I call it my third startup, because, we're technically a venture capital firm. We're actually structured like an operating company, and we're really, an operating business whose business happens to be funding startups.
Gotcha.
And so really my whole career trajectory from straight out of school has been entrepreneurial. Really started and ran 3 different businesses, all doing that with partners each time. So I have 2 other partners at Right Side Capital. And, I love what I'm doing now, because it's, a combination of me both being entrepreneurial, or having been and created this, and then getting to work with entrepreneurs of all different types, every day.
So a couple of contextual things that are interesting there. You kind of moved out west right at the time where essentially the Traders 8 had left. Venture capital became an industry in like the late 70s, right around 75, I think is when it started. And you were there in the early 80s. Was it something that you were aware of when you started the first workstation company, or did you bootstrap that? Sounds like you bootstrapped.
No, that's bootstrapped. And that's completely, so although venture capital existed in sort of, in the 1970s and 80s out here, and everyone knew there were VC firms, the concept of being an entrepreneur was sort of unheard of. So even though I graduated from Stanford in 1992, there was 0 entrepreneurial resources there. I knew one other person, and I knew a lot of people there that was actually doing their own business, leaving school. And for the most part, when people asked me what I was doing after I graduated, and I said, oh, I'm starting my own company, they'd look at me like I was crazy. Like, what do you mean you're starting your own company? It was just unheard of. I remember driving across the Bay Bridge to a place in Berkeley where I could buy a book that taught you how to incorporate yourself. That's.
I think I bought that same book. I think I bought that same book several years later.
Yeah.
It's funny. I think back and I tell people all the time, I was kind of on probably that last curve of folks that didn't really know what it was doing it, and didn't really know why I was doing it, but it wasn't a thing. Like, entrepreneurship was a word that was really hard to say and it's harder to spell. I graduated in 98. And then I went out west to grad school. And at that time, because it was 98, we were in the peak of like that .com bubble. And so there was grads, like Babson had a program on entrepreneurship. San Diego State had one of the top 20 programs in their MBA program on entrepreneurship. And so there was definitely some formation around curriculum and what is this thing and how do we define it and how do we move people into it. But it was still very early and no one knew what it meant. And if you told somebody you were an entrepreneur, they laughed at you or thought like you were doing something illegal or that you just should have gone to school longer, right? It was a different time then. Yeah,
completely. And one of the things I always found interesting, and I mean, I think this didn't really change even into the 2000s, is eventually into the 2000s and 2010s, you sort of people learned the economics of how venture capital worked and how fundraising worked, but you never actually learned the skills in school to be an entrepreneur. You don't ever learn in school, like, how do you hire people? Like, what are the skills around that? How do you manage people? Like, what makes a good boss? How do you get the most out of your employees?
How do you
pick all things I learned by trial and error, and mostly by error, making mistakes and then figuring, I got to do it differently next time.
Yeah. I used to have hair. That's how we used to say. So that's a great backdrop. So what you mentioned, that you kind of came through the sales hunt too. Everybody kind of comes up through a different path when they're an entrepreneur, but you definitely, were knocking on doors selling pieces of cake. So you were more of that kind of go to market, opportunistic, probably problem solver. And you even sold paint jobs, via a tiered structure.
I sold Cutco knives in high school too.
I was going to say, Cutco did a lot of good out there in the world as far as training people how to sell $1,000 knives.
It's the best sales training I've had to date, or that I've seen, was that, and I got it when I was 17, and it served me well.
Yeah, it's funny. The first ever sales job that I ever did was actually an internship. It was like promoted as an internship, and I just knew I needed the skill. Like, I didn't have the skill. I had the motivation, I had the energy, I had all that, but I knew I didn't know the science of it. And I also was like, I got to somehow understand this whole tech thing. And there was an internship for a company in San Diego called Z57, and all the people that started that company were ex Cutco. Like, they were like top of the food chain Cutco.
Yeah.
But they were selling small business websites in 1998, 1999. And I always joke, I'm like, we think about the world today and like all the technology and everything else. And in 1999, I was knocking on doors in Del Mar, California, walking into realtors and small businesses and saying, do you want a website? And they would just say no. Like, they literally would just say no. I didn't sell a thing for 6 months. It was a great education because I learned how to take rejection as well. But, to think that 25 years ago, you couldn't sell somebody a website.
Yeah.
Right. I mean, like, it didn't matter what you price it at. They just didn't want it. And here we are today, and we have agents buying from other agents in their own social network, right? Like, when you think about that exponential leap in.
Yeah. But it's an interesting lesson, what you just even said there, which is, and this is just true. It's always been true. And I've said this to launch a lot of our founders along the way, is it doesn't matter if your product is going to work and solve a problem for a potential customer. If they don't perceive that is a need and perceive that they have a problem that needs to be solved, you're just not going to sell it. So, like, what you have to have something that works and is going to solve some problem or provide some value, and the person on the other side has to perceive that they need that. And sometimes we have companies that fail, and every customer they sell loves their product, and yet they just can't get over the hump that people don't perceive they need it.
Yeah. I'm thinking of some funny sales stories from some guys I knew that sold Kirby vacuums, but we'll leave that for another time about creating a need. So, all right. So talk to us now about this evolution. So you are a entrepreneur by both life experience and DNA, and then you created a entrepreneurial capital allocator as your third, kind of startup. What does Right Side do in the market? Who does it do it for? Why is that timely? And what is the perceived value that your customer, your startup founders have that you kind of show up and immediately are different? I know it says no BS on your website, but kitschy phrases and hooks aside, talk to me about your fit in the market and who you're serving and why.
Yeah, I'll talk to it. I maybe even start with how it sort of came to be. So in 2008, I had sold my software company. I was sort of thinking about what to do next. I had been a sort of somewhat active angel investor on and off from the mid 1990s to the mid 2000s as I had time. And I got reconnected with someone I had known at Stanford and, had interacted with in the 90s. And he's a friend who, is one of these people who sort of dreams math models in their sleep a bit, and just sort of, I was an engineer by training, but sort of he's a solid notch more, advanced in math and sort of quantitative thinking. And we were talking, and he had just read this book called The Black Swan by Nassim Taleb, which at the time wasn't world famous at all because the financial crisis hadn't happened. He read it because this was written by a quant option trader, and he was interested in it. And and basically what this book said is it's not a book about finance. It's a book that defines this term called a black swan. And a black swan is an event that in foresight seems impossible to happen. And in hindsight, just everyone weaves a story how it was obvious and everyone saw it coming. And in the book, the basic theme of the book is that everyone's lives are basically defined and impacted by black swan events more than almost anything else, and no one's aware of it. And my partner, Kevin, reading this, had this epiphany, and he said, I bet, black swans bend both ways. You can have positive black swans. And if we take that definition of it, almost all successful tech startups are positive black swans. And at that time, if you looked at, say, Google and Facebook as two prime examples. So, if you went to the early 2000s, 2000 when Google launched to the public, I don't remember the exact date, but at the time, search was viewed as a solved, mature market. The last thing anyone thought anyone needed was search engine number 14, out there. But you jump forward a handful of years later, and everyone's talking about how it's obvious search was ripe for disruption. And the same thing with Facebook. When Facebook came out, there was Napster, there was Friendster, there was MySpace, and these were large, successful sites with masses of users. And the last thing anyone perceived us needing was a third sort of friends site. And then just a handful of years later, everyone was talking about how it's so obvious Facebook would be successful. So these are, so he had this epiphany and he said, I bet most of the returns in the tech space are tied up in these black swans where you can't even tell what they're going to be in foresight. And they probably more than the returns from that more than cover the returns from the losers. So this was what he had in his mind. And he thought, all right, what's the quantitative model that takes advantage of this? We need to, could you invest in a way that you did so many investments, you could be first checks in. If you could be a first check into every tech startup in America, it'd probably be a strongly positive return. You'd have very low risk, and it would all be about capturing these positive black swans. And so we started talking, and the question was, all right, how many investments would you need to make to start to replicate that market and capture your fair share of black swans? You're not going to get every one. And could you smooth out the risk curve of this market? Could you produce a really high rate of return? And could you smooth out the risk curve so that it's not that risky? And basically the market has this crazy high return because nobody can diversify enough. So everyone's taking this sort of irrational risk, when they're making these early stage investments. So could we harness the risk premium without really taking that risk to diversification? And when he came to me, it was more of an operational question. He was like, hey, would it be possible to invest in hundreds or even 1,000 companies per year? And so I started looking at it, and I'm like, well, operationally, it'd be infinitely easier than the hardware company or software company I just ran. So I was like, yes, we could do that it'd be fairly straightforward. And so we started working more on the math model, moving it forward. And then, a year later, we came to the conclusion there was a there. As we asked more and more people and started talking to wealth managers and more sort of mathematicians who knew the space well. And we ended up launching in 2012. And basically what right side capital is, now that's a long sort of origin story, but it'll help you understand what we do. So we're basically a quantitative, data-driven approach to what we call pre-VC stage investing. And what we do is there's two or three very unique things about us. One is that our funds are ultra diversified. So an average venture capital firm will have 15 or 20 investments in each fund. A very active one might have 30. And we have many hundreds of investments. Each fund typically has 400 plus. So that's one unique aspect of us. Another unique aspect is that we invest in a segment of the entrepreneurial ecosystem and market where all professional investors pretty much ignore. And that is these very small round sizes that can be are being raised. So for the most part, even like pre-seed stage VC firms are still investing in $1 to $2 million funding rounds. And we looked at the entrepreneurial world in the early 2010s, and we said, there's this whole market that exists where companies are looking to raise $200, $300, $400,000, and no professional investors address that at scale. So let's do that. And just fundamentally, if you can play in a market in a space where where supply and demand's in your favor because you have no competition in the product you're offering, returns are generally more in your favor, or you can charge more for your product if you're selling something to someone. And then the third thing that's unique about us is that we don't evaluate companies by trying to predict if that specific company will succeed or fail. And this is the biggest thing that's different about us. Like as an angel investor or as a VC firm or private equity firm, every company you're doing diligence on, you're trying to project that specific company forward in time. Mm-hmm. You're trying to decide, will this specific company succeed or fail? And what we do instead is we have a view of the world where we're putting together portfolios of investments. And we have the mindset that an actuary would have, putting together a pool of insurance policies, or an underwriter would have, putting together a pool of loans. And so we're looking at a company and we're turning it into a profile. And what our algorithm is really sort of asking itself is, if I invested in a pool of 50 to 100 companies that are this same profile at this specific price matters a lot for us, how would that pool perform? And if we think that's a high returning pool, we're investing in that company. And so I can't tell you if that specific company will be one of the ones that succeeds or fails within that pool. And that last bit there, the concept of investing in a profile of a company at a price as opposed to this specific company, is the biggest difference between us and everyone else that invests in tech startups.
Yeah, no, there's a lot to unpack there. I mean, all of that logically makes sense. I think it's purpose built for the times we're in and moving in more and more every day. So that there's a lot to unpack on that. But I want to pick up on a statement. You may have answered the question in that last piece, but you made a comment about how operationally, what we would call in the business spraying and praying, right?
Yeah.
I mean, you're algorithmically spraying and praying. If you were to do that, when I first heard you say it's easier than the hardware business I just stopped running, I kind of wanted to know why. As you said that last part, I feel like you answered my question before I asked it, but I don't want to assume that that's true, because the reason why I feel like you may have answered it is because you very clearly, that third piece of that puzzle, which was, we bet on essentially a persona and a category. And some people might see that as a trend or something, but it's not that. It's you're kind of going back to, what is that perceived need? Where is it at in some sequence of time, right? In other words, are we early? Are we on time? Are we late? And then, is that sustainable? In other words, is that need only going to permeate and continue to grow? Or is that need going to evaporate, get competed out, get replaced by some other perceived necessity? And if you bet that it's here to stay, whatever the thing is, right? Like that, then you want to own as many exposure points to that line of arbitrage you can. So that's the model. So I think what you did was you said it's easier than the hardware startup because essentially you're not
operationally it's easier. What I meant, like if to actually go ahead and operationally implement this would be easier internally operationally than running the hardware company or running this software company where we're in 20 plus markets and each market was had its own unique.
Well, and you're also dealing with supply chain and disruptions and parts and volume and things like that. Whereas in your world now, you can kind of algorithmically figure out, well, what is the supply of new starts across the world, because you're not limited to a geography. And if you can figure that out, which sounds like algorithmically you have to some degree, right, then you can kind of understand we're going to have persistent deal flow against rising categories for the foreseeable future. And if we can convince capital that we've built something that is, harder to replace than it is to just join, then they will allocate their pro rata of their, funds to us that go into venture and high risk. And we will create a consistent return for them that meets their target because we're betting on 400 things versus 20. And because those 20 that are in that same category across a seed or a pre-seed angel group, or the other people that are in your kind of category of market, that $200,000 to $400,000, that first check, they don't have 400 deals that they're in, let alone even exposed to. So they pick the 20 best that they have access to. But then there's 20 more firms like them doing the same thing.
Yeah, and more importantly, they tend to be competing in the same market. So like it's more of an efficient market once you get to the segment of sort of funding round sizes where there's multiple professional investors participating. Pricing is much more efficient, right? Whereas and this is the thing that we learned. Like sometimes it's just in the same way that for startups in the startup world, a lot more luck and randomness is involved in what companies are wildly successful versus not. Even on the venture side, there's a lot more luck and randomness involved. And for someone like us, even though our whole system is sort of to take that luck and randomness out, we have benefited both from being good and in the right place at the right time. So I'd say when we launched in the early 2010s, we were mostly smart beta. Would be a way to describe what we're doing. We're indexing this segment of the entrepreneurial ecosystem that you can't get exposure to any other way unless you're actively participating as like a semi-professional angel investor. But you still couldn't do it with the diversification that we're doing. So that was sort of our niche, and we were being able to offer this product up to professional investors. And we did that and it was working well, but we also were at the right place at the right time in that when we launched, it still took on average $500,000 to $1 million to build a software product and get to where you could get it to the point where you could sell it. And that seemed incredibly cheap at the time because 10 years earlier that was 5 million and 20 years earlier that was 20 million. But that price still collapsed over the next few years. By the time you got to 2016, 17, 18, it was maybe $100,000 on average to build a first version of a software product and be able to prove if you could sell it or not. And so that happening caused this explosion of startup activity. And suddenly there were 3 times as many startups looking for funding, but there were still no professional investors in our segment of the market. So now suddenly there's a lot more demand, there's no more supply. And so supply and demand just went more and more out of whack in our favor each year. That's one thing that happened. And then the other is that the cream of the entrepreneurial crop just looked better. So like most of what we invested in, it was pre-revenue in 2012 and 2013. And by the time we got to 2017 or 2018, we were investing almost exclusively in companies that had already launched a product and had 5 to 20,000 a month of revenue. And we were paying the same price for them. So the quality of what we were investing in got so much better at the same price. And what's interesting is sort of, if you want to see economics at work, that happened for us. So eventually our costs went down, quality going up in price, staying the same is actually, sort of a decrease in price. And across the venture world and the startup world, pricing was going up strongly in that same time. And so it just sort of showed that we were participating and playing in a different world that with different dynamics. And then the last part that we didn't realize for a few years was that, we built this fast, transparent funding process. And this is sort of our website, the VC with no BS. We actually state exactly on our website, exactly what it is we invest in and what our target profile is. And we want you to try and figure out if you're a fit or not. And if you don't bother reaching out. And if you do, here's a form to fill out. And we respond to everyone that fills that out. And almost no other VC firms do this. Like, go to a VC site and, they invest.
The only guy that I know that's doing something proactive like that is Draper, with some of his more recent stuff. But I want to talk to you about that time horizon, because I'm curious how you differentiate from AngelList, because at that same window that you were talking about, that collapse in price, right, to get to MVP was happening, that window of 2013 to 2016, AngelList kind of had its moment where a lot of high net worth. I mean, I was on AngelList and I was more follow-oning because I was like connected to guys like Brad Feld doing some stuff in Colorado at the time with Startup Colorado, mentoring across a bunch of different places from Techstars, the Founder Institute. And Brad had kind of like his own personal, account there, and you could follow him. And again, AngelList made it easy to follow somebody that was a good picker, and you could just say, I want $1,000 or $5,000 into each deal that he writes a check into. And so I'm curious, because that mechanism, to your point about Friendster and MySpace to Facebook, I mean, that mechanism isn't new. That mechanism was happening before Right Side, but you guys took a novel approach to it and did some unique things differently. So for those who are familiar with AngelList, how did that trend line go out? How did you guys compete back then? What is your take on the state of the union now with regards to that? And what is uniquely different? Was it who you went after as a LP to serve, or what was the approach?
Yeah, well, at a high level, just the market and demand for these small rounds was so large, like no individual participant or coming in could come close to meeting demand. So I mean, at the high level, nothing that was going to happen was going to rebalance supply and demand. But what AngelList, when they came out and sort of made a big ripples in the pond, in the mid 2010s, and for a very small period of time, they were a way, and their initial goal was to match investors and entrepreneurs. Right. But that actually didn't work that well, because what happened is very quickly, and this is a problem with a lot of the platforms, you have all these startups that put their information on there. When the platform first comes out, all the information about the company is relevant because it's up to date. And then very quickly, companies stop updating their stuff because they've raised a round or they went out of business or something happened. And then as an investor, that platform quickly becomes not that useful because there's not much, too much of the stuff's irrelevant or out of date. I don't know what's real or not. And what happened is within a few years, AngelList really became the LinkedIn.
Right, it became the job site for getting a job inside of a funded startup.
Well, it became the for both. Well, that's even the next iteration. At first, it was the LinkedIn for fundraising. So you would create a profile, put it up there, but you would not get any random inbound people offering you money or wanting to talk to you. You would then do your own outreach and sales process, and you drive your own potential investors to your AngelList profile on your site. And it was just a tool, really useful tool you'd use to try and fund companies to try and get funded. And so that's really what it emerged to be. And that's what was really powerful for many years beyond that. And you did have some people doing syndicates, like you're referring to Brad Feld doing that. But there's, that's something that I think a lot of some individual investors would do and follow, but it's not something that like the larger family office or wealth management firms would ever think of doing, or professional investors, because there's just a lot of problems with how it was set up. Like number one is it's deal by deal carry, right? It's not pooled carries. So the person leading the syndicate is not really incented to try and have a great return over the whole pool. They're just trying to invest in deals they think they can get other people to invest into, because they can make a lot of money even if the pool doesn't do well, because they make money on each company. So that's one thing. Number number two is that, the motivations of the participants vary a lot. So a lot of people who are from the venture world or who are doing their syndicates there, their motivation was to get companies funded, and then so that they could then write larger checks as a VC firm maybe later. And that's sort of going to be focusing on capital intensive business models, whereas our focus was on capital efficient. So, there's just a lot of different things that made it such that really wasn't ever serious competition for us.
I wanted
awareness.
I wanted your take on it, not because I saw it as competitive, because like you said, the supply and demand couldn't be met by one firm no matter how fast. But I wanted your take on it because I was curious as to your assessment of what they actually were doing, when they were doing what, and then
they were
where
amazing.
They do. And I think you did a great job kind of contextualizing in time how they had to evolve, and also how they filled a need in different moments that ultimately then made them less relevant to, call it, smart money or to sophisticated allocators, because the noise level became too high, right? Similar to an NFT marketplace or something, right? It's like, how do I curate what I actually want to do? And so you just made a comment. I want to pull back to something you said earlier about perceived value. Was the perceived value that you've locked in on in your business model around capital efficient allocation? Or what is the perceived value that you bring to your
perceived value from like our perspective as an investor and our investors, or perceived value from entrepreneurs that we're investing in?
The money. Because I think the entrepreneurs, obviously they're the gladiator, they're important, but the linchpin has always been the money.
Yeah. So this is an interesting question, because this gets back to sort of a statement I said earlier, not knowing that it would come around to this, but that you have to have a product that it's not enough to have a product that works well to anyone that buys it. People have to perceive they need it and want it, right? And one of the interesting things for us is that, the value that we add for our investors is we're this sort of more rational, sane way of investing in venture capital. So the return of venture capital as a whole, we think, is the median return is pretty mediocre considering how locked up your capital is and how illiquid it is. And so when we looked at that at first in the 2000s, when we were looking at everything, we thought, all right, well, that doesn't seem like an attractive, career path for me. I said for me to go on, it's like I have to outperform 80% of my peers to have good returns, and they're all smart and they've been doing it longer than me. And I won't know if it's working for decades. And then we found this other segment of the entrepreneurial ecosystem, and in the 2000s, angel investors were actively investing there, and returns were actually really high there. And I won't go into why. There are a bunch of structural reasons why. And when we looked at that market, we said, this might be worth our time. We could be worse than average going after this segment of the market and still outperform the median of the venture world and get a good return for our investors. And that means a good return for me as a fund manager. So that was, our initial value prop is that we capture this high return the market pays to induce investors to invest at this stage when it's incredibly risky. And the reason that really high risk premium is there is because it's not perceived that any individual can ever diversify enough to smooth out their risk. And so the market has to pay this huge return to induce investors in. And so at a high level, what we're doing is simply becoming a casino where we put the math as tailwinds at our back. We're going to place lots of small bets where we're collecting this really high risk premium, but the greatest source of risk, which is this idiosyncratic risk that each company is more likely to fail than not, sort of is mediated away, by our diversification. So it ends up with this incredibly attractive risk-adjusted return. You're taking very little risk at a fund level, and you have this very high returning.
Essentially, to use your casino analogy, you're finding 400 of the best poker players you can find to go sit down at Bellagio's floor, and you're placing a bet on every one of the hands. And so even though the house always wins, the power law of the person in that 400 that takes home their disproportionate share pays for the rest, and you're going to get it because it's a law of numbers.
Yes, and actually to use that poker player analogy a little more. So actually in the 90s, I was a semi-professional poker player as well. And the thing that matters the most as a semi-professional, professional poker player is not your personal skill set. It's what table you sit down to play at. You know, I can be the best player in the world, and if I sit down at a table with lots of other great players in it, my expected return isn't that high. I can be me, a semi-professional poker player who's going to be much worse than a pro, but if I sit down at a table with a bunch of mediocre players, my expected return is going to be quite high, and there'll be a bunch of variance. And so that's the concept of the profile. It's not just that we're, you know, can be a skilled investor, like that skilled poker player, but it's, you know, what table you sit at matters. And that's what profile you invest in many times over and over matters a lot. And, you know, part of our DNA as a firm, as we've evolved, we've realized that, you know, one of the things we're surprised at is that there haven't been other firms that have figured out what we're doing and tried to replicate what we're doing. And a lot of that is just, it's outside of the box. It's operationally so different than what other VC firms do. But this has made it such that supply and demand has stayed massively out of whack, you know, in our favor.
Well, it's also
a multi-decade period, and I think it'll continue that way. And so that's how you get excess returns.
I think that new entrants could happen in the next couple of years for a variety of reasons. But I think part of, and this is just my 2 cents, my opinion doesn't mean it's accurate, but I think part of the reason why you haven't seen other people copy you is because of what you said earlier, which is someone who is in venture capital and is in the top tier, that 5 or 10% that make all the returns while everybody else never raises a second fund. I mean, to get a fund, number one, is very difficult, because the first question all LPs will ask is, how did your last fund do? And so if you're new to it, you can't say that. And so you're kind of done before you start. And then to your point, if you're going to go attack the model and try and go do early stage, but be like everybody else, you have to outperform the bottom 80%. So then smart people are going, well, I think I'll just do something else. Like, and then if you're in the game and you've had a couple of wins, whether they were by talent, luck, or some combination of the two, you can raise money in perpetuity over the last 15 years. Like if you look at the last 15, money was free, the arbitrage was great, the risk premiums were high. So essentially, you know, you're getting all the money. If you had a return, if you had a Twitter in your early one, if you were like one of the tier ones that everybody knows, then you have a line of investors trying to get into your fund and you're turning them away, and everybody else is kind of trying to pick up the scraps, right? And so I think it just it wasn't broken. In other words, for the people who were making money in the business, it wasn't broken. And so you came in with something novel and you kind of carved out your little piece of it, but everyone else is just going, yeah, but I don't, you know, I'm doing something else, or I'm already good. And I would be interested to see how that evolves moving forward. I think now with the world of agentic AI and with these, you know, 24-hour MVP ship cycles and revenue generation, and then, you know, an 88-day zero to, you know, decacorn scenario being kind of the most recent case with OpenClaw. Like, I think that the need and the supply for what you do is going to be magnanimous, which means you've already kind of proven it. You're ready to go. So you could probably go raise a lot more funds and do a lot more deals, but other people will start to pick away at the rest of that volume because you won't be able to eat it all.
No, we won't. And I mean, and what's interesting is it's everything you said is true, but we have largely been, for most of our life, selling a product that nobody wants, which is interesting. Because, and we didn't know this. This is one of these things.
And when you say that, which side? The entrepreneur didn't want it, or
the entrepreneurs want it and do backflips?
Yeah,
so like,
but the LPs did.
The LPs, we didn't realize at the time, because none of the three main partners came out of the venture capital world, and we didn't realize how offensive our model was to the venture world or to investors in the venture world. So it turns out we break almost every perceived practice in the venture capital world, and particularly in the 2010s. So the universal consensus was the only way you have outsized returns is small concentrated funds, right? Because if you look in the top quartile of fund manager performance, there's small concentrated funds. Well, that's because if you have less investments, there's more variance. There's also more small concentrated funds in the bottom quartile too, but no one ever looks at that. You know, the other thing is we don't do any follow-on investing. We invest all of our money
at
earlier stage.
Ask if you do follow-on, but you just answered it.
Because the excess returns are so much higher at this segment, and the you get much more efficient markets as you get to seed stage and beyond. So we deploy all our capital at this one stage, and that goes against sort of the gospel in the venture world, where the marketing story that's told by venture to its investors is we invest in a bunch of small amounts in a bunch of companies, see who the winners are, and then double and triple down on those. And it's a very good marketing story. I don't think any math backs it up. And what actually happens as a venture firm is if you're a Series A investor and you don't invest in that Series B round, that company won't raise money because you've sent this negative signal flag to the next round of investors. So in reality, you have to double down on every company that keeps raising until it's socially acceptable for you not to invest anymore, because the company's grown so far beyond your stage. And then the third thing that we don't do is that is very different is we don't take board seats. Like everyone perceives that, it's sort of silly, but people, a lot of the professional LPs think that if you don't sit on the board and oversee entrepreneurs, the cars will always spiral off the track. But especially at early stages, I think board members often hinder as much as they do help companies. Like it goes both ways. And entrepreneurs actually can manage much better than people think with just getting regular advice as opposed to these structured board meetings. And then also the quantitative data-driven approach. In today's world, that resonates really well. But in the 2010s, the perception was, well, anything quantitative is horrible. That just almost destroyed the world in the financial crisis. So what was interesting is we went to market and we're selling this thing, and our returns are really good. And we're on Fund 6 now, and we're launching Fund 7 next year. So the returns have all worked out great. But boy, it took a really long time of banging people over the head with returns until people were willing to get comfortable with the fact.
It reminds me of, just to kind of keep it light, but I don't know if you're a baseball guy or not, but it reminds me of Moneyball. And I love that scene in Moneyball, the movie with Brad Pitt, and when he's talking and he's arguing with his scouts, right? And the scouts are like, well, I like this guy. Okay, well, why do you like him? Well, he's this, that, and the other. He bats this, he throws that. And he's got a pretty girlfriend. And then the one guy goes, he's got an ugly girlfriend. And like they're literally debating this. Like, we can't draft him because he's got an ugly girlfriend. And the one guy goes, why? And he goes, no confidence. No confidence. We can't do it. He's got no confidence. And Brad Pitt's just shaking his head and he's looking at his quads and he's going, we're not doing it, or we're doing this because he gets on base. And he's like, well, he's batting 200. Yeah, but he gets on base, 7 out of 10 times. Well, why does that matter? Because getting on base is the only way that you can get around the bases to score a run, and the runs are the only thing that separate winning a game from losing a game. We're here to win games, so we're going to get guys that get on base and like change the model, right? That quantitative approach. And so when you think about entrepreneur, and especially early stage, everybody wants to find the next Steve Jobs or the next Zuck. And so I would imagine a lot of your conversations were, well, how are you going to find me that person, right? In other words, how are you going to find me the superstar with the pretty girlfriend? And you're going, yeah, it doesn't matter. I'm just going to get people to get on base in a category that's growing, and we're going to do that enough times. We're going to score more runs, and our returns are going to predict themselves, right? Like, we're going to take a math-driven approach.
Exactly. We refer to ourselves as Moneyball for startups. Like, even in like 2010, we'd use that analogy. It's just that analogy makes a lot of sense now, and it resonates. In the 2010s, that analogy sort of, people are like, well, that's crazy. You can't do that with startups.
Well, it also violated the culture, right? The mystery and the wizardry of being a good venture capitalist, right? Like it violated, like you said, the culture that also is inherent to it, right? That I somehow have this special power, right, to select the winners. And
human brains don't want to believe that there's a lot of variance and randomness that can't be predicted by a really smart human. Like, our brains are wired to tell narratives and stories about everything. And these narratives and stories let us predict the future. And it's just, no one wants to believe. Like, I even think a lot of investors that invest in us, even though they know it works because they see our track record and everything, in their hearts, they want to believe that a really smart human with a gut feel is going to be what performs the best. And that's just human nature. Like I once, it's interesting, we once had this fund of funds that, they had a mandate to invest in emerging managers from California, and they were not that far from us. And we had got to know them over years. And at one point I was in their office in the mid to late 2010s, talking to the senior person there. And I just said to him, I knew well enough in my my sales background, just cut to the chase. I don't understand why you're not investing in us. We take off everything you're looking for, and we outperform almost all your portfolio. Why can't this happen? And he just looks at me and he said, all right, my honest answer is that if we invested in you, we'd be admitting that everything we've done as a firm to this date is wrong, and how we evaluate managers and all this. And I'm not willing to do that. And I don't think my investment committee is. And I was like, all right, I was so happy to hear that, because I was like, all right, at least that's, psychology is what dominates the world, right? And that dominates decisions. And at least you know what you're dealing with at that point.
How has that shifted in the last 24 months or not? And what fund are you on now? So you started this, like you said, it was an uphill slog. I think if you were back of the napkin, if you were writing 200 to 400 checks, and you said 200 to 400K was the sweet spot, you needed 40 to 80 million dollars in the
well,
first.
We started out writing much smaller checks, and so our first fund was a proof of concept. So our first fund was 6.5 million through direct investments and through doing partnerships with startup accelerators where we could write even smaller checks. We invested in 279 companies. So that was our least diversified fund, and now our fund 6 is 55 million, and it'll be, it's gone, from 6.5 to 16, 17, 32, 33, 55. Our next one will probably be 75. And all of those are sort of 400 plus. And the profile of what we have invested has never changed, just always companies, capital efficient tech, raising sub 500K rounds predominantly. And we've gone from being, 30 to 50K of that round to 2 to 300K of that round, a lot. But yeah.
Do you lead in price, or do you?
Yeah. So we almost, this is a sort of a post-COVID thing. So we've always led in price, and or almost always. We don't have to, but say it's 2017. The typical company coming in, they're looking to raise 300,000 or 400,000. And they might have some angel investors swirling around them, but none of them want to actually lead and price it, because no one knows how to price something this early or doing it. And we would come in and say, hey, we'll lead a $250,000 round. Will be 75,000, and that catalyzes 150,000 of other dollars that had been looking at this company for 8 months to finally close, because this professional investors come in that had a brand at that point and put their stake in the ground and said, we're investing at this price. And maybe that round never would have happened if we didn't do that. Post-COVID, it was a different world, because you had this period, 2020 and 2021, when it was crazy frothy, and that worked. But really from mid-22 up until the the middle of last year, it was a fundraising desert for the startup world. And so we couldn't say to a company, hey, we'll be 100,000 of your $300,000 round. It's your job to get the other 200, because none of them would get it.
Right.
So we started being, most to all of the round more often than not. That just gave us another tool in our tool chest that made us even more valuable to entrepreneurs, helped us get a little better pricing yet again. And, and that's, I think, and now that our funds are larger, that's sort of where we're at almost all the time.
Yeah, and I think that's a moat. And I say that I'm hearing this in real time for the first time, so I'm just going off top of my gut, right? But I think that's a moat for you guys for a couple reasons. One, you've organized the capital. You're now in Fund 6. The size of the funds has continued to grow. Your ability to take down a full $200,000-$300,000 round today versus even 2 years ago,
completely different,
is such a lever, because $200,000 to $300,000 today buys you $3 to $4 million worth of production 2 years ago. And in 12 months, 200,000 to 300,000 is going to buy you $30 million worth of production. So your ability to basically on success raise another fund and do another 200, 300, whatever the deal size needs to be to get the exposure variance you want, and to be able to not have to have the entrepreneur defocus to go out and find the other whatever, which I think that's hard no matter what the market is. But like you said, for the last couple of years, it's been near impossible. So you're basically giving them nothing, because you're going, we'll give you 100, you need 300. It ain't going to happen. They're going to run out of money, or you're not going to write the check because it's contingent. And so it just becomes a waste of everyone's time. what is your take on, especially, you know, the last 30 days, 40 days, right? Like we now live in a whole different world than we did even 45 days ago with relationship to the speed of production.
Yeah, everything's changing so fast. And I think what, you know, it's one of the things that's interesting, and this is, you know, a little less relevant for us because, you know, more than half our investments fail anyway. But if you're like a seed Series A investor or later in the venture world, it used to be, and by used to, like, you know, 4 years ago, 5 years ago, 10 years ago, it took 2 or 3 years for you to look stupid in an investment that you made. Now you can make an investment and look stupid 6 or 9 months later because it's like, holy cow, why did I invest in this? This product's like been disintermediated by some new change or something that's happened. So yeah, it's a really challenging period. But on the flip side, like everything that you just said is so true. Like one thing that's interesting is that there's been this, you know, 30, 40-year trend of it just gets cheaper every year to build a first version of a software product. And we were in the right place at the right time when that price collapsed. But it had never gotten cheaper operationally. Like the price to build out a sales and marketing team and scale, that, if anything, got more expensive, you know, I think over, right. You know, and in the last 2 or 3 years, that world's changed. Like we have never been in a period as investors where we see within our portfolio companies, suddenly the operating overhead to build and scale is just so much different than it ever has been. And yeah, it's just crazy. Like what we think is going to play out is that we're going to, if we look out over the next many years, we might have a higher failure rate than historically because maybe more of our companies will fail in the first 1 to 2 years than they did previously. We've always been surprised how small that number is, but that's going to be balanced out. We're also going to have some companies that are just crazy successful within 2 years that you could never dream it was possible for a company to be that successful. And they won't have raised a ton of money to do it. So we won't even have been diluted that much. And those home runs are going to be so much bigger and faster than ever happened before. And that more than makes up for those losses. But it's that diversification makes such a difference.
Well, I mean, you know, Pete from OpenCloud on the interview that he did with Lex Fridman, you know, was very candid about kind of some of his burn. I think he was spending, you know, 18 to 20,000 a month upside down between, you know, the API call, all the stuff building it, right? But if you do that math and you go, okay, extrapolate that out, and then let's say you're not worth 100 million like he was from a prior exit, and you need to draw a check. You know, you're talking about a 12-month runway is $300,000, right? And you could own a significant portion in the early stage while the entrepreneur still owns the majority of it. And who knows what he exited for? And again, it's an extreme example, but we can kind of do the math of there's going to be a lot of base hits and singles.
That's a positive black swan, by the way. What you just described. But
yeah.
What happened with that?
But in other words, let's say it doesn't exit for whatever Sam paid him, a 5 billion, 10 billion, whatever he got over time to get absorbed by OpenAI, right? Let's just say it was $100 million, like the guy from Base 44, right? Another one that predates this by maybe a year. Base 44 goes from 0 to, I think, a couple $100,000 in monthly recurring revenue with a solo performer, no venture money. I don't know how they capitalized it or if there was an angel or two in there, but it doesn't matter. Sells for 80 million bucks 6 months later. So if you think about it, I turned 300,000 into my fund's portion of 80 million inside of a 12-month gateway. You didn't break any records, certainly in the world we're in today and moving forward too. Those kind of base hits are going to be too many to count. And so the disproportionate IRR could be very rich.
Yeah, that's everything you've said is true. And, you know, I didn't talk about it before, but another part of what we aim to build as a firm when we launched is, you know, the reason we've been capital efficient is we wanted to make it such that $100, $200 million exits were meaningful for us because we're getting in at low valuations and it's still a high multiple return and the company hasn't raised a boatload. And, you know, that's just unusual in the venture world. You know, an $80 million exit, most venture investors are licking their wounds and moving on to their next investment where we can print a really high return. And that's, I think, an important aspect. And everything you're saying is correct. It's a very fast changing world. It's the most exciting time to be a very early stage entrepreneur. I think it's one of the most exciting times to be a super early stage investor right now because we're sort of at the right place at the right time again with the strategy. It's a challenging point, I think, to be sort of mid to late stage venture because you're trying to figure out how you fit in. And will as many companies even need these series A, B, C rounds? There'll still be demand for them, but maybe a lot less companies need them than.
Well, and I think PE finds a new value because the consolidation that has to happen and will happen is just going to be dramatic, and that's a whole different animal, and so those cycles will probably happen.
Yeah, it's
again,
a different world.
Your mechanics are definitely more hitting a tailwind. Like, you're coming into the market full speed right at the starting line when everyone else is going to figure out what happened. I need to get a play there. Like, you're 6 funds deep and, well warmed up, fully stretched, right? All like, with pattern recognition. I mean, like I said, I think there's, top of my mind, personal opinion, I think there's a tremendous moat. Doesn't mean the moat couldn't get competed away.
By the way, some of our moat is also, we've been doing it so long, and now we're not a 3-person team, we're a 12-person team, and we have, we give you sales, advice and expertise. We give you marketing advice and expertise. We've got a network of 1,400 next stage investors. Whether your next stage is seed VC or late stage private equity, we can connect you to. There's just all this value add and resources, monthly webinars that you get from taking our money that you're not getting from taking someone else's, and so that's a selling point too. So there's a lot of stuff going on under the hood.
Yeah, I think everything had its run, right? Like, there was a real value to the Techstars of the world, and to the Boomtowns and the Founder Institutes and the myriad of different accelerators that kind of filled that void 12, 15 years ago, right? They timed it right. There was no place where you go get not only strategic, but you could also find someone like you in a room because they're mentoring, but they're looking for their next thing to ride. But now it's like, that's too slow. So now it's like almost that's kind of come full circle. And now what I need is I need capital efficient, get out of my way, strategic. I need something like what you have. I mean, and because otherwise everything else is like a brake. You're putting a brake on my gas pedal. And what I need is a little bit of money so that I can focus on this thing full time, because there's 100 other kids or whatever doing it. But if they can't find the same capital, that gives me the ability to kind of just not worry about my credits or my token count or whatever as I bang through stuff. And maybe they don't know. Maybe they're in some town that doesn't have access to great salespeople or anybody that knows what they're doing. But now through your network, they can kind of do this.
Something you said there is such a huge thing, is like, if you went back 15 years ago, all the venture capital dollars, all the money flowed through New York, Boston, and, Chicago, and New York and Chicago is emerging. And then, now innovation happens everywhere. It doesn't matter what city you're in, even what country. Matters what country for acquisition. A lot more acquisitions still happen in the US. So we're still probably like 85, 90% US. But a lot of our founders are overseas founders here with huge operating teams overseas, where it's much less, the costs are lower, selling into the US or a global market. But yeah, but you could be in some small tertiary city in the US and it just doesn't matter anymore.
Yeah, and again, getting started doesn't necessarily mean where and how you finish, but it's important that you can get started, and that's been the unlock. And now the ability to scale the OpEx side efficiently as well as the software dev side is literally our reality. And today is the worst that's going to be. And so, when we're talking about the doubling and everything, I just think it's a very interesting time. So my question to you is, with the fund, I mean, at what point do your mechanics get overwhelmed, if at all? Maybe they don't. But in other words, like you mentioned 55 and you think the next one's 75. Like, in my mind, and I'm not promoting you here in the sense of just like being an idiot. I'm just saying, in my mind, there's no question like you could have a $250 million fund.
Yeah, the demand's there from the market.
Because at that point you're doing too many deals, or in other words, is there a discipline there that says, look, 100 million is the max we want to deploy because it breaks our math? And I'm just curious, because then that means there needs to be, 10 more of you.
Yeah, I don't think so we're built, something I said early on, we're built like an operating company, not like a typical venture capital firm or private equity firm is a few partners, they're the luminaries that pick the deals, sit on the boards, and everyone else is admin or staff to support that. We're not. We have all these functional units within our business. We can scale pretty large. The issues are, from what you said, the market can absorb a lot more dollars than we're deploying. At some point, we have to decide, it's us ramping up operations. So we wouldn't go from being a $55 to $250 million fund in a next fund because we wouldn't feel comfortable operationally that we could do that and be certain that we could provide strong returns and operate smoothly to our investors. So there's a big jump that can happen, but we would always limit. The one thing we will never do is change the profile of what we're investing in. Where VC firms always get in trouble is they're successful at this stage, they raise a much larger fund, and hey, now I'm not investing in companies raising sub 500K rounds. I'm writing $1 million checks into $2.5 million rounds, and suddenly you're doing something different.
I almost see it.
We don't want to do that.
Yeah, I almost see it as the opposite for you. If I was to play it out, like I go, where are you at in 24 months? Like, I almost see it as the opposite, where you have your own feeder. Like if you would have one where you're 25 to 50K and the round is sub 100 or whatever. And then you'd have the 200 to 300K round that just leapt ahead because they came in. And like, I just see you guys being able to go broader and smaller, not.
So what you just said is interesting. I can't say like what the channel is or anything, but like I was just talking last week with a potential channel like that, where we might be able to at scale get to invest in companies, at much lower valuations and just write 50K checks into companies that already have a live product, which would have been unheard of, a few years ago, but it's just possible now. So yeah, we're always looking for new ways in which we can, find attractive profiles that we can invest in at scale within this universe that we're in. And if it means doing something slightly differently, but within the sub 500K funding round world, every extra tool in a tool chest is a great tool. So,
when I think about every time you read about this stuff, we think about, oh my God, we're going to, where are the jobs? Where is this going to happen? What's going to happen here? And we hear a lot about right now, like blue collar millionaires are benefiting from AI in the current cycle, right? Because there's not enough electricians, there's not enough drywall guys for the data centers, there's not enough, right? And yet every single one of those things is not just a profession, it's also a small business. And there's thousands of them, and they do 5 to 10 to 15 to 20 million a year, which means they're too small for PE, but they're profitable. They're probably under systematized. But somebody who owns that, or somebody's kid who's in that space and understands it, has very specific pattern recognition and goes, you know what, now I could build out an agentic solution for dad's plumbing business with 15 open claws or whatever, right? And I can basically make this thing more profitable, and now it's more fun for me to run. Well, at the end of the day, if they got 50K from you and they built some solution that other plumbers could use, what does that look like? I mean, I could see a world where all of a sudden your 50K created a whole roll-up in a business that couldn't be rolled up by private equity. So you're almost feeding the other asset class of private equity venture, because you're going to spark the innovation that happens that takes non-technical business and turns it into something that can be a systematically acquired enterprise.
Yeah, software usage at scale is just going to go through the roof. It might be that a lot of the business models that were used to sell software, get disintermediated and get blown up. And, we've seen lots of industries get blown up over time, throughout the last 150 years.
Yeah, I have this notion. I don't know if you have a thought in this, Hunt, or not. Mine's more of like a thought, like just a funny, how funny would that be historically, which is when the internet first happened, when the Napster moment happened, right? We moved from the world of selling copies of whatever, software, music, film, right? We stopped moving units and we started moving streams, or we started selling access and licensing access and renting it and, exchanging it for data and all that. But it's almost like we're coming full circle with software again, where instead of the Microsoft Office being $4.95 on a CD-ROM in a box that I bought off the shelf and I put in my thing, then when I traded computers, I could bring it with me, or a tape deck that I could copy 15 times and dupe for my friends, but buy it once because I wanted the album cover art. We're almost going back to now with GitHub business models that'll be volume-based, where it's like, hey, it's open source, and I'll keep all the updates are free forever, but you got to. And then they're just going to sell volumes of copies again. And except this time, instead of it being on a CD, it'll be on a GitHub repository that you just API in. And I can see a world where open source, as it continues to scale, comes up with almost a units-based volume sales approach.
Yeah, everything is, and that's already the change that's happened in, you know, the quote unquote technology world. Everything's moving to consumption based pricing away
Right.
from.
And agents are going to buy that way because agents aren't going to buy like humans, and so they don't need it packaged into SaaS, which a lot of people are well aware of, but maybe haven't thought about it on this more simplistic level. Like agents are doing the majority of buying moving forward, whether we like it or not, and humans will still be a factor. But again, the web is being re-architected for agentic visitation, right? Web MCP, all that stuff. It's a great time to be in your business. I would imagine that the LP interest is strong. How do you kind of vet LPs? What are you working with? Are you in family offices as a syndicate? Are you focused on, you know, working with fiduciary advisors and people and creating like an alternative asset fund of funds, or like where you just
Most of our investors historically in the 2010s, our investors have primarily been direct high net worth individuals, smaller family offices, and then a number of wealth management firms that put their clients into us. And then as you've gone into the 2000s, that stayed there, probably an increase in wealth management firms that we're dealing with, and then now some actual institutions that are putting.
And what is the fund of funds model or the fee structure model for wealth manager people that may be fee based? Like, are there duplicative fees? Is there a different?
How do they charge? Well, most of the wealth managers, you know, they're charging their clients something off of the pool of assets.
Right.
So we're just pool, you know. So the wealth manager is coming and saying, all right, you know, they're not using us for every client of theirs. It's like, hey, we have this smaller subset of clients where this would be a good product, and we're going to decide that we think that 2% of their pie should go into this, and we're going to allocate for this client. We're going to put 2% into here, or they come up with some percentage, right? Or maybe they say, hey, it's going to be 3%, but it's going to be 1.5% in this fund and 1.5% in the next fund, or it's going to be 5%. You know, we're part of the asset allocation pie for, you know, wealth management, wealth preservation that gives also a decent return. You know,
and are your fee structures? So they may not tack on one because they have 1% of the AUM total or whatever.
Right. They're not tacking on extra carry fee or anything. We're just
as a sponsor, are you getting 2 and 20, or what is the model?
Yeah, our model is 2 and 20. Okay. And one of the things that makes us really attractive to wealth management firms is we're an alternative investment that will not blow up. Like, you know, one of the big risks and what you hate as a wealth manager is you put your clients into something. It's a natural gas fund, or it's a small venture fund or something, and that thing performs poorly, but it keeps existing for many, many years. And every year it kicks out a K1 that just reminds your investor that, oh God, my wealth advisor put me in this thing 6 years ago and it sucked. And I get reminded every year when I get a K1. Well, because our funds are so ultra diversified, like we don't have those blow up scenarios. Like you don't lose a client. We never make you look bad. We make you look good. And also our funds are very tax efficient. Like most of our gains end up being tax free federally and in 45 or 50 states. And there's this section of the tax code that addresses investments in what are called qualified small business stuff.
I was going to ask, how does the QSBS work? I thought you were going to go there, and then I'm thinking, but my interpretation of it might be limited because I thought you had to hold the stock in your name. So is it because the self-directed
So what happens is you have to buy it directly from the company. So it can't be a secondary where you bought it from some other investor. Right. And it flows through, it's actually even the opposite. It flows through pass-through vehicles. So our funds are limited partnerships. And even if you invested in us through an LLC, it flows through. And what's interesting is there's this, and that tax break was just improved last year by the tax changes. Right. It's 15 million, but it's not 15 million per company, it's per investor per company. So we can invest in a company and we could put 200,000 in and get $50 million back. And that's all tax-free because it's sliced and diced by our investors, and all of them are getting less than 15 million from that. And the way it used to be that you had to hold your investment for 5 years to get the tax-free gains. Now
it was like 5 to 7.
Yeah, now you get 50% tax-free after 3 years and 75% after 4 years. So.
Yeah, so I'm familiar with QSBS. on a personal level, because one of the startups that we did exit in 2017, fortunately, we did QSBS with it, so it was 100% tax-free gain. It was held for 7 years. This was before the change, right? So you had to hold, I think you had to hold it beyond 5 for the 100% treatment back in the old version, but whatever it was. I wasn't aware that you guys could do that for your LPs. That's a huge advantage because, again, now you're getting, I mean, when you factor that in, it makes up for all of the risk.
Yeah, our post-tax returns are just crazy. And it even gets a little better. There's a section, so that section is, you know, the QSBX section is section 1202, but there's a section called 1244 that doesn't apply to the regular venture world, that applies to us. If you're part of the first $1 million into a qualified small business, and we almost always we're part of the first million in, if you have a loss, your loss is not a capital loss, it's an ordinary income loss. So we can pass that through too. And you can get up to 50,000 per taxpayer, 100,000 per couple per year. So yeah, it's there's a lot of stuff
per investment. Is that per investment?
No, that's per taxpayer per year. So that your limit on that one, you have a limit per taxpayer. But yeah, so you know, we happen to have what's interesting is we invented this strategy for investing that was just purely designed to optimize risk-adjusted returns in this space. And it turns out, you know, it was also optimizes tax efficiency. It looks like we hand wrote the tax code and built a strategy around that, but that's not what happened. But, you know, we have an investment strategy where a lot of companies fail. Most of those failures we pass through as ordinary income losses. So it's like a tax credit against income. And then most of the gains come out tax-free. So our tax rate's really nice. Our fund one has a tax rate either of about 0. You know,
wow.
Many multiple returns.
What is the target IRR for Fund 6, like based on the historical kind of?
Our target IRRs, we target 20%. And, you know, the funds, there's some variance. Some are going to be higher and some are going to be lower. But that's a, you know, because we're giving you that as a post-tax return, which is really crazy when you adjust that to pre-tax,
right.
is our goal. Obviously.
Yeah, post-tax 20 and net of fees is still in the high teens. So, and what is the, sorry, you got my brain spinning.
Yeah. And
so
even there's variance on returns. Like all of our funds, we don't have any blowout funds, but like our fund one is like 26, 27% post fees. Like it just crushed it. You know, I think that's an outlier. But yeah, it's just pretty crazy. You've experienced getting it out tax free. It's weird when you get it, because I'm an investor in all our funds. When you get a distribution and you don't have to pay taxes, it's like almost feels like you're doing something wrong. It's like I get to keep that. You know,
we call that a really good day.
Yeah. Except in California, I still have to pay state taxes. But hey.
Yeah. Well, yeah, you know, you can't get away from that right now, but maybe we'll get our crap together and figure that out. So that being said, you know, where do you get your deal flow? Is it mostly direct registrations on the site by entrepreneurs? Is it where does it come from?
Yeah, it's all over. You know, at the beginning that was one of our challenges, but right now it's just from all over. So we work with a lot of startup accelerators, get managing directors of those companies, you know, introducing us to companies mid-program. We have a huge brand. We're out there. If you're, you know, in Texas and you look for top 10 investors in this type of company, there's a good chance we're in that list. So we've got a lot of articles written about us. We get a lot of random inbound. We also now have, you know, at any point in time, we have thousands of active founders out there that are from our existing portfolio companies, and they're scouts on the ground that are constantly funneling, you know, other entrepreneurs towards us. We have this huge network of next round investors that are constantly sending us stuff that's too early for them. There's just no dominant sort of source in today's world. It really comes from all over. But yeah, a lot of our huge winners have been total random inbound.
What if you were to think about where you guys are a year from now with all the things that are changing, what do you see as the biggest challenge operationally that you have to solve for?
Operationally, right now, we're humming along. I don't think we have any huge operational challenges. I think what changes more now is that in this rapidly changing world, the attractive profiles at what prices changes more quickly than it did previously. So we're constantly having discussions about that. You know, what's nice is that a lot of what we invest in is led by entrepreneurs. So we're really investing in the efficient frontier of capital efficient entrepreneurs. And so, you know, we could have told you in the mid to late 2010s that blockchain is going to be big because we got tons and tons of blockchain startups applying for funding suddenly. Now, most were not very capital efficient. So they didn't fit our profile, but we saw that before anyone else. We saw, you know,
well, that's going to come around too. I think the dynamics of that come around full circle now because AI forces that into relevance, which is now you get 2 bites at the apple because you could be on the equity table of the development lab, so to speak, for your 200K, and you could mandate you get a 2-for-1 on the token issuance if and when they launch a foundation and a token that contracts to the roadmap with the, and so now you have 2 bites at that apple potentially.
Yeah, if the crypto ICO world comes back and stuff like that can happen.
Yeah, but also, yeah, and also just in general of a lot of those entrepreneurs may now be the ones who are leaning in heavy with the agentic AI stuff. And so even if that one wasn't the thing, now they come back around or now they have a new idea. How much of the jockey versus the horse? I know you said you had a funny horse story, but you mentioned this earlier too with the personas. Like how much of the jockey
that's
versus
changed
the horse
a lot because you know back in the early 2010s, almost everything we were investing in was pre-revenue. So we had a very strong emphasis on characteristics of the founding team. We wanted you to have previously run a startup before, raised capital, managed people and budgets, because we didn't want you to operationally implode before your product even got to market, because that was a big risk. In today's world, you're starting in the sort of the late 2010s, that became a non-issue because we're investing almost entirely in companies that have revenue. So if you're going to operationally implode before you get to market, we don't care because you're not in our visible universe anymore. You've imploded before we would look at you. So once that change happened, you know, the characteristics of the founding team mattered less than it did before. And so we started being willing to invest in more young entrepreneurial teams. And so I think that's definitely true. Like, so we bend, you know, that's where some of our algorithm characteristics change over time based on the market. So we base our decision much more on actual real world metrics and traction and business model in today's world than the founding team. Founding team matters. We're looking at characteristics like, you know, technical capabilities. You know, it is a plus if you've been a founder in a startup before, you know, and have raised capital, have gotten a product to market. It is a plus if you've managed people and budgets, but it's not 100% requirement anymore. And, you know, it's balanced out by a lot of the young teams. They have lower overhead too, right? So there's pluses and minuses all around. You know, one of the things we've been talking about a little internally lately is that marketing is going to matter so much more in the world going forward, because in any area that you're building, you know, it used to be there's only a certain number of competitors that had a product that was good enough that they could succeed in a market, you know, and then beyond that, it was sales and marketing execution. You know, in the world going forward, there's going to be an infinite number of companies that have a product that works and provides value. And it's going to be brand and customer acquisition is going to matter more than it ever has. And that's going to be a new experience for the entrepreneurial world. But that also means that younger teams that are very social media savvy might have more edges over some of the senior teams that don't have that.
Yeah, I think you're hitting on the where I'm landing right now, which is if there is a moat that you can have in this world of bringing something to market that's software driven, it's going to be heavily dependent on distribution.
Yeah.
And so how much of the distribution are you able to, you know, start with or control or influence within that small little founding team? And if you have personal brand, if you have influence, if you have network effects, or even just as Kevin Kelly wrote years ago, 1,000 true fans, you don't need millions of followers because followers don't really count, right? It's that they count in an advertising centric world, but in a world where product moves and utility is, you know, it's trust and attention, and 1,000 true fans could be the exact thing that unlocks a massive.
Well, OpenClaw is really a marketing story. It's not a technology story, you know, and that what just happened. And And the technology, the marketing, and the guerrilla marketing go from nothing to what they became in just a handful of weeks is really the story. It's not the technology that drives what they do. The technology.
Well, and it's beyond user generated, because it's the marketing that basically they call it viral, but really it's ground up. It's user driven. It's everyone saying, I just launched my OpenClaw. In other words, it's the sense of ownership that is being created in these communities of common interest, or not. And so the founder's ability to do that before they meet you or use your money to go do that is probably a good use of funds, right? It's very exciting, interesting times. I mean, you are going to have a bird's eye view and a street level view all at the same time of this next crazy 12 to 36 months. That is no question.
Yeah, it's a really interesting time because we're investing in, I mean, it's a mix of everything. Like, we have such a large portfolio. Some of the companies in our portfolio could be ones that are disintermediated by stuff that happens. And a lot of the stuff that we're investing in are going to be, creating these new models, doing new things, and they're doing new things with agentic, software, and agents that you just couldn't have dreamed of just a couple of years ago. And, the high flyers that are going to come out of that, we think are just going to be so exciting to see. And, that's one of the things when you've been around and you're doing it a long time, you've got a mix of a lot of existing and stuff and a lot of new stuff, and change is always exciting, and change is always both, it's always more exciting for the new stuff, and you have to help your old companies navigate through it as well.
When you talk about the science of your term sheets and the time horizon, you mentioned you guys are having conversations around, I think you didn't use the word valuation, but I kind of implied that you're thinking about price and round and like terms as it relates to kind of your, I don't want to call it cookie cutter, but your standard kind of bounds, right? You're like upper and lower bound. What is that today? And, what is it if someone's applied on the website and they had a deal and they met the criteria, they fit a persona, what's the time to funding, closing, and what's a typical term sheet expectation? I know you said you're being really transparent with a lot of it online. And because every venture capital model that I have, they say there's no return and no, right? Like they always say, there's no return in saying no, because that entrepreneur might not come back when they have their next idea, and their next one might be Airbnb, right? But all that phraseology and kind of culture aside, I mean, you do get to a yes or a no, I'm assuming relatively fast.
Yeah, we gather up data. We're a yes or no, usually within a week, sometimes in just a few days. And then there's a diligence process to validate that everything that's been represented is true. And that can take another few days to a couple weeks, depending on how quickly we get data and what's involved in validating that. We're typically investing in most companies, typical rounds are somewhere between most commonly a 200 to 400K round. And it's usually at a $2 million to $4 million valuations, the most common, occasionally exceptions at $4 to $6 million valuations if the traction level's higher, or it's, just really rapid growth. It's, what we didn't understand when we launched, we built this really fast, rapid, transparent funding process for our own selfish needs, because that's what we needed to build out an ultra diversified portfolio. And within a few years, we found out and discovered this is the product that entrepreneurs want and covet, right? If I can get this small round done quickly, it's not a lot of dilution, and you save me 5 months of distraction where I can focus on growing instead of just talking to investors the whole time. What we found is that product actually resonates the most with repeat entrepreneurs, because they know how painful it is to invest, and that's just been a big bonus for us.
I think it speaks a lot of volumes around the underlying confidence you have in your mechanics. And I say that because I wasn't expecting you to say roughly 10% is the sweet spot, right? Like, especially given no follow-on.
Yeah, but we're not, sometimes it's not always, like we might invest 150K in some company, it might be at 2 million, and we might be at 150 at 5 million. We don't have to invest a higher amount when it's higher. We actually are only focused on return multiple, and we don't even care about our ownership percentage. But yeah,
no, that's what
we do have higher ownership than you would think. Yeah,
that's what I'm getting at, is that like, a typical early stage VC is like, well, I'm going to come in with whatever the check is, doesn't matter, 150, 500, and it's going to be 25%, and it's not based on anything other than their cascading math of, well, 80% of you are going to fail. I'm going to double down on my winners. I'm going to have to pay to play in the A round to keep from being diluted. And when I do that, I want to end up with 8 to 10% at exit on my winners so that I can return the whole fund. And I'm going to do that twice if I'm good. And that's going to justify the other 80 bets I made or whatever that are dead or walking wounded. And that math equation just got blown out too, because if you're saying, like, we understand what our total return on the fund is, and if we can own 6% of XYZ for this, but we have 15% of that, like, we're not greedy. It's not even that you're not greedy. You just understand your math to a level where when I ask you a very direct question, you could have dodged it or you could have couched it. You're just like, well, usually we're basically 2 on 2 or 400 on 4, or sometimes it's a little higher, sometimes a little lower. But if I net it out, I'm just going, okay, so you're only taking 10% of my deal. Like, take my check, please. Like, LPs don't think that way. I've talked with so many accrediteds about startups and stuff, and it's like, oh, they're too rich. Their valuation's too high. I need 50%. It's like 50% of nothing's nothing, dude. Like,
exactly. And I don't think people understand too that, like, when you give your customer the exact product they want and desire and it fits their needs, you get a better price than they do a backflip and are excited to get it from you. And so we give you a quick response time, a lot of value add after the investment, and we're fearless. We don't mind being the only money in to your round, which almost no one else is willing to do. And when you combine all that, and it's a small round, it's not a lot of dilution, it's just a great product for entrepreneurs. I wish it was around when I was an entrepreneur.
Well, and I think it's also, I mean, yeah, I mean, I'm glad it's around now. I'm going to pitch you 3 deals when we hang up. But you know, yeah, I'm not joking. No, I'm just kidding. But not really. The point is the LPs win too, and I think that's a really unique thing, is that you've proven this now. So, you know, this isn't something you're hoping works. This isn't something that's like, hey, because the agentic AI economy is here now, we have to do it this way. It's like, no, we've been doing it for 15 years, basically 12, 15 years. And now it'll be the standard, because the velocity, we have to move capital into positions where it can make more of itself with risk-adjusted returns in the 16 to 20 more rapidly. And right now we've got to unlock $7.5 trillion in money markets that's earning 4 going to 3. We've got to unlock all the dry powder that's trapped in these long redemption periods. You didn't say what the redemption period is. Is it a 7 to 10 year fund life, or what is it?
Typical like, we're a 10-year fund with 2 1-year extensions, and we want most money to come out. I mean, that's the everything sounds great. It's like this really attractive risk-adjusted return. It's mostly tax-free, but you have to understand your money is locked up for a long period of time. Like, we want the winners to take many, many years, because that's what makes them tax-free, and it takes a while for some of this to play out. Yeah, well, there can be some crazy quick winners, but it's fundamentally a very illiquid investment. So that's the catch, is you put your money in and you don't know exactly when it's coming out. We return money as liquidity events happen. You can go through some.
So there are
happened, and that delays liquidity. You can have frothy periods like 2020, 2021 that speeds up liquidity. And as an investor, and as you can't change the macro world. You just have to live through it. And so that's why we're a very, very rational piece of most high net worth individuals' asset allocation. And you have to we're always very transparent when we talk to investors. It's like, here's the pros and here's the cons, which are mostly liquidity that you have to understand, and you have to understand, what's right for you given your situation.
Right. Well, I mean, at 2 to 5%, I'm not thinking about that money for 10 years anyway, and
right.
I want to know I'm compounding 16 or 20 a year at tax-free rate. Like, I can kind of set and forget it, and
multi-generational planning is like most of the people investing in us are thinking like over a very long term.
Right. Yeah, they're trying to. Right. Yeah. Interesting. I'm sure we could talk a lot longer. That was a lot of valuable insight and unpacking of your business model, your timing in the market. Any following thoughts or final thoughts you want to leave the audience with? Any asks of the audience?
No, it's great. I think it's been great talking with you. Anyone wants to ask any questions or pick my brain about anything, always happy to talk with people. You can just email is the easiest way. Just reach out to me at dave@rightside.capital.com, and
we'll put all that in the show notes. Dave Lambert on the Atomic Level. It's been great having you. Thanks for listening, everybody. We'll see you next time.
Okay, thanks, Chris.